Good morning, everyone. Welcome to this update for global stocks and commodities for the 13th of August. Well, it was certainly a pretty tumultuous week, really, with a lot of things centered around North Korea. The market did take a bit of a dive on Thursday, but steadied on Friday. And looking at all things put together, I still don't see any reason to be concerned. Yeah, sure, there might be some short-term triggers that might take the market down, but this is I don't think we've seen any change in matters at all. So let's jump in and have a look at what this week holds. So in this update, I'm just going to give you a little bit more flavour and detail around some additional services that will be launched in the next week or two, and I'm going to show a working example, which I think is interesting, or in fact two examples. Going to take a look at the consequences of the rhetoric between Trump and Kim, and really the consequences have been nothing so far, despite the bit of disruption on Thursday. And just in general, look at how markets are behaving. And I'm posing a couple of questions. Why is it that markets keep rising when sentiment has been so poor? And that's been the case now for about 3 years. Ever since 2014, every man and his dog wants to tell you why the market is topping or why it can't go any higher, and yet it's still kept rising. So sentiment has been awful, but prices still keep rising. So why is that? And I just want to take a look at the reality of what actually happened last week. A lot of people are pressing the panic button and trying to call a top, but we're a long way from that. And what did it show for the next few months? So I guess that's really the key. So just a few more details on this new service. And as I explained last week, this really has arisen because I get questions from non-members, some of which I can't answer for licensing reasons, and also in fairness to paying members, I can't answer it. And there are many questions that I can't answer in the way that I would like. And so I'm really addressing that need that is out there, and trying to provide services in the most appropriate way possible. So that's the background. So what it will look like is it's going to be fundamental and charting analysis, quite detailed, and that could extend to stocks you already own, or perhaps stocks that you might be thinking of buying. So that service will apply basically to everything. It'll cover US and Australian stocks and ETFs. And what I intend to do is to analyse specifically the aspects that you want, the part that is important to you. So rather than providing a service which I determine the content, and there will be some of that because I'll be addressing the overall market picture, but this is going to be a service very much directed towards the analysis that you particularly want. It'll be a high-level education service. This is not going to be basic fundamental analysis or charting. This is going to be at the higher level. So if you're looking to expand your education, then I think this is an area where you can upskill yourself very rapidly. The key aspects that I'll be looking at, obviously, there are two things that occur in the market. We either get a reversal or we get a pause prior to a continuation of the trend. That's it. There are no other alternatives other than those two things. So there are certainly chart patterns that can point you very clearly to whether we are in a pause or whether we are heading for a significant reversal. Obviously, is there a breakout brewing? Again, there are signs that are really indicative of that. When and how to enter to the best effect. So how to get the best entries with the lowest risk entry parameters. Certainly, you could do a lot better than just chasing prices after they've already been going up for a few days or a few weeks. And of course, really importantly, and this is where I get the most questions, I think, from anybody, and that's when and how to take profit. It is the most challenging aspect of trading. It's the one that most people struggle with. And again, there are some very straightforward things that you can do to improve your performance dramatically in that area. So I just want to look at a couple of working examples where I look for changes of character that precede a major move. And I'm going to look at two stocks. One is AEIS, which is a US technology stock, and the other one, of course, is Citigroup, or used to be known as Citibank. And also, as part of the new service, there's going to be a series of educational videos and tools that are going to be available for purchase as well. So let's jump in and have a look at those couple of examples. So let's just look at AEIS first of all. And I'm just going to cover this briefly. In this new service, I'll be covering this more thoroughly. But let's just take a look at this stock, AEIS. So we pan back, we can see that it's been in a tremendous trend, came out of a base that formed from 2014 to 2016. So it really started its run about 18 months ago. And that was about an 18-month to 2-year base formation. Now, as you can see, the price went remarkably higher. It just kept trending up and up and up. And all through this period here, there was really no sign of any sort of change of pattern at all. Now, the first time that we got a sort of a warning sign that that things were maybe getting a little bit excessive was on this first evidence of excessive selling. So we got a huge gap higher, and then we traded down during the day, and it was all done on big volume. So that was a point of short-term excess. But what you'll note is that what followed it, so rather than panic and assume that this is a top, you need to look at the action immediately after it. And what we saw, of course, is that there was no retracement. And the volumes dropped right away. There was no follow-through. So about 4 or 5 days after this, what looked like a fairly ugly reversal at the time, there would be no follow-through. So it was almost certain that this was going to be some sort of reaccumulation before the next advance. And in fact, that's what happened. We then jumped up from the mid-60s and went up to around 70. We formed another base during that period, but again, modest volumes and no real evidence of this breaking down despite this big candle here. So, don't be put off by one-day events, and that's why I'm not being put off by what happened on Thursday in the US, and that is that at this point in time, it's a one-day event. So you always need to follow what happens after it. So after that, we then advanced further, and then we got a very significant deviation. The price was way above the 50-day moving average, and we got a significant reversal on the 9th of June. So that then needed to be monitored closely, and so we got then a significant down move that we hadn't seen before. This is a change of character. This is the price doing something that it hasn't done before. The elements that we can look at, higher volumes on the decline. You can see through here, higher volumes, and they were sustained. We broke a support. So here was a key support level here, which corresponded with this last peak in March. We went straight through that without a pause. And we went down to, guess where? That the previous level of resistance had now become support. The market bounced from there. We then got a rise, quite a healthy rise, but you'll notice that the volumes aren't all that great. They didn't get up to the levels of before. So all of that trading tells me that we're most likely in an extended trading range, rather than this being a top and the start of a new downtrend that might take the price down, to perhaps 40 or something of that nature. Now, I think the overwhelming odds are that we've got a trading range in our hands, and that creates opportunities, either to trade the range or to monitor it for the next breakout and the accumulation of or the start of the new uptrend. So there's one example, and there's a lot that we can learn from this chart analysis. Let's look at Citigroup. Citigroup, if we pan right back, you can see used to trade up around $600 before the GFC. So this peak occurred in 2007. It got absolutely smashed into the ground during the GFC, but has been accumulating this massive base since 2009. So we can draw some basically key support and resistance levels. So picking up this peak here, and some peaks here as well. And then we also had a little bit of an overrun here. So we can pick up on that one as well. So we've got a massive base, and I can tell you that when stocks form such a huge base as this, when they break out, the breakout goes on for a long period of time and can go a lot further than anyone imagines. So I think over the next couple of years, this isn't going to unfold overnight, but over the next couple of years, I think there is massive upside potentially in Citigroup. But of course, there'll be corrections along the way, and it's all dependent on how you manage and enter that trade. So the key aspects for me, we've got a huge 8-year accumulation base. We've got a strong quality rally. You can see the volume that's come in as this rally has moved up, first of all, to the first resistance level and then to the second one. And it's no coincidence that the market pauses and then turns down again from these resistance levels. So a long-term resistance level caused the market to fall, but where did it fall to? Exactly where you'd expect it to. We bounced, we had a test, and then we started forming some higher lows. So there were some good signs here, and this is in January of this year. But the market wasn't ready to break out yet, so we got another pullback. But look, this time the low is higher than the previous lows. And then so that we then get a series of higher lows, 1, 2, 3, 4. We then get lesser reactions coming back from the resistance level. So these are all indicators in advance that Citigroup was building up to at some stage in the next few weeks or next few months, was building up to a breakout. And eventually that breakout occurred. So that's the sort of analysis that I'm going to be doing in this new service. Let's move on. American stocks, just an overview, just at a big picture level, and this is not anything to be overly concerned about or sign of a top, but there are many overcrowded trades in the market. Eventually they're going to unwind, and one of the things that I'm watching very closely is the VIX index, because a lot of people are short the VIX. In other words, they're betting on the fact that the VIX will stay down where it is. Now, eventually there'll be something that'll cause the VIX to go up, but we haven't seen it as yet. But that is such a crowded trade, and it is such a leveraged trade that I think ultimately when that gets unwind, the ramifications are going to be significant. So that's one I'm watching very closely. I posed the question, why has the market been rising for 3 years when sentiment has been average at best? And the answer that I would give you to that, who's doing the buying and why, sentiment is poor because that's the sentiment of the retail investor who is reacting according to their emotions, according to their hard wiring. But the cool-headed, smart buying are the institutions and the major players, and they're the ones that have been doing the buying, and they've been buying because they look forward. They don't react to emotions, and they don't react to what's happening today. They look forward to what's happening in the future, and they've seen the signs in the economy, and they've seen the signs in the corporate earnings growth. So they're the ones that are doing the buying, and they continue to do the buying. And they're the ones that dictate where the market's going to go, not the retail investor. So that's why the market has been rising for 3 years when sentiment has been so poor. For me, one of the key technical indicators is market breadth. It's an outstanding leading indicator of markets breaking down. In fact, when you've had major bull markets, you find the market breadth starts to fall apart. Anything around a year or longer before the ultimate top in the indices. So it really does give you a heck of a long time. And market breadth is still fine. That's why I'm not concerned by what happened last Thursday. And the other key thing is that events around wars or major conflicts or terrorist acts, they're not lasting. So the events around North Korea or Trump, whilst they're, if things really got bad, they could be catastrophic. they're only the catalyst for short-term selling, and the impacts are not that lasting. Your focus should be on earnings in the economy, because ultimately that's the driver of stock prices. It's not events like North Korea. So if that's what you're anguishing about, then stop, because it's not where it's at. There's the market breadth. You can see the red is the S&P index, which is the left axis, and the blue, or might look a bit black to you, is the advanced decline line, which is the market breadth. And you can see that it's still rising and hasn't shown any weakness. So that's saying that there's still the majority of stocks are still advancing. We're seeing no weakness. The market is not tending to fall over. Reporting season in America has gone really well. 73% of stocks have beaten expectations on earnings, and we've seen revenue growth in every sector, no exceptions. And that revenue growth on average has been around 10.2%. So that's as good as reporting season as I can recall in quite a number of years. The other key thing is that people have been calling peak in margins. They said it couldn't go on. We'd seen the peak in margins, but margins are still rising. So that's very, very positive. Earnings growth, the sector with the highest rate of earnings growth the earnings beat, I should say, that should read, is still the highest for technology stocks. So technology stocks are beating expectations with the highest percentage of all the sectors. Healthcare is leading the way on forward guidance, which is again a very key indicator. Healthcare has made some gains recently, but they're showing the highest level of forward guidance. That's a real positive. The US dollar is finding some support. We're at a critical level. It's probably going to be tested. We'll have a look at that. And a slight overrun of support to the downside happens a lot. So don't panic if that happens. Now the S&P index fell by 41 points on the week, and that was mostly all on Thursday, so it was significant. But we did steady on Friday, so far it's a one-day event. And the other thing that I noticed too, looking through a few hundred charts, is that volumes at the stock level remain pretty modest. There was no significant selling in terms of volume that occurred. So let's take a look at the S&P. So you can see we've pulled back to the 50-day. Yes, we broke a short-term support. So we broke that little support there, but given how elevated we were, that was always going to happen. So the other levels that I'm looking at, obviously here around 2410. We've got another level here at around 2400. And look, really, we could really come back down to here. I don't think I would be getting overly concerned until we sort of broke below about 23, 25, something of that nature, broke the 200-day moving average. That'd be something that would make me sit up and take notice. And eventually the markets all return to the 200-day moving average. So the issue of this having a more sustained fall is not about, is the main trend over, because that wouldn't prove that it's over. That would really just be about coming back to what markets normally do, and that's at some point they return to the 200-day moving average, and we perhaps then go into an extended accumulation range. But at the moment, we've not seen anything that suggests that this trend is reversing. Now, obviously, the next few days is going to be critical. So when I get back to you next week, we'll have some more information. Let's look at the US dollar index. That's at a key level. So there's the big picture. Really key level here at 92. We've had a little bit of a bounce for a few days. We may get a retest, and as you can see, we had a little overrun here in May of 2016. We may get another little overrun here, but this is critical support. So what happens to the US dollar around this level is very important, because it will influence other asset classes. So there's some key things to look at. Aussie stocks, our dollar slipped just a tad down to 79. And most of the drivers, the iron ore price, amongst some of them, and certainly our economic health, would appear to be unsustainable for us to stay at 79. A lot of it is due to speculation in the futures market, and the positioning in the futures market for the Australian dollar is at an extreme, and therefore is subject to reversal at any point in time. And once these reversals occur in the futures market, then because futures players are so leveraged, then they have to get out of the way quickly. And so those reversals can be quite sharp. Now the ASX 200 was lower by 27 points on the week. And overall, large caps flat to down in terms of their price and their business outlook. It's the small and medium cap stocks where you want to be looking for advantage in the Australian market, and particularly ones that can employ disruptive technology and or are global facing. I think that should be your focus in the Australian market. Precious metals, gold fell by 33. Sorry, it didn't fall. Silly boy. I should have updated this chart. It actually rose by $33 to $12.92. Pays to proofread. Major trend line breach to the upside in gold, as we'll see, but we've still got a key horizontal support at 1300. And to me, that one's probably more important. I certainly would rate that more important. GLD holdings of the ETF were unchanged at 787 tonnes. So despite the significant build-up in gold, the gold price, it would appear that things hadn't really changed too much, enticing people back into the ETF market. So probably mainly in the futures market. Precious metal stocks, no momentum yet, no real follow through on precious metal stocks. We saw a few better signs, but really nothing that would get me overly excited at this stage. So I think precious metals, still a work in progress. Let's just look quickly at the ASX 200. So we're still stuck in this 5,600 to 5,900 range, and even tighter range over recent months. Let's turn now to, we'll turn to gold. So we've got this big rising, this big falling trend line from the peak in 2011. You can see we've finally breached it during this period, but we've still got to overcome these highs here to show that we're out of the woods. And if we zero in on the daily, you can see it's been a pretty good period. We've bounced off these lows down around 1200, and we're up almost to 1300. But it's still got to get through here yet before we're out of the woods. And if we look at GDX, then this is on a weekly chart. So this is the chart I put up last week. You can see we got a little bit of a gain in GDX, but you can see it's nothing much in the context of this big basing pattern that we've got going on here. So these are the things that I'm looking for. A run up to resistance on rising volume. We don't have that. Candle range expanding. We don't have that. Shallow pullback from resistance. We don't have that. And of course, we don't have a breakout either. So nothing really showing in GDX at this point in time. Commodity stocks, copper advanced slightly to 289. It's really just about currency fluctuation. Crude oil was down a little bit, and but stocks were weaker. So again, we're still seeing, as with gold, we're seeing a big accumulation pattern and no sustainable momentum at this point in time. So we're still in the accumulation phase for energy stocks. There's the copper chart, and there's the oil chart. So to wrap it all up, the trends are unbroken, and that's the key thing that you need to focus on. Embrace new highs. Don't be scared by them. The stocks that are performing well are continuing to set new highs, and if you look at the trends that I've been showing over the last couple of years, they've gone on a lot further and a lot longer than anyone possibly envisaged. So don't be put off by new highs. Embrace them. There is a way to get into them. You certainly don't want to, just buy them any old place because you may have to put up with a few weeks or a few months of downturn. So wait for the dips. Demand an edge. Let the market come to you. And above all else, don't let emotional hard wiring take over. I've read a lot of panic in the last couple of days because of what's happening in North Korea. That's not what you should be focused on. So stay with the strength, stay with what is. If it's going up, then it's more likely to continue to go up than to go down until it shows you that it's not. The sectors that are strongest are that for a reason. It's because the smart money's buying, and they're buying because they're looking out 6 months, a year, 2 years. It's not the retail investor that directs where this market goes. So that's a fairly lengthy wrap up for this week. There's my contact details for non-members, and I'll, as I said, the new service, which I think will certainly be appealing to a lot of people, will be launched in the next couple of weeks. So that's it for this week. Cheers.